Hey everybody, this is John. Welcome to the free video and another magic close near 2100. We kind of closed at 2100 the end of month, which was Tuesday, Wednesday expiration, and then today. And so we had iron condors or iron flies at the 2100 level all week this week, and it was pretty fascinating. That's kind of like just trading on the same side as the market makers, and that worked out fairly well. So the question is what's setting up for next week? You've got some interesting patterns. Facebook right now obviously slamming into some resistance here, has got a daily squeeze, but you can see today couldn't quite cut the mustard. The Qs today also had a tough time with the disappointing jobs numbers. And the main thing to keep in mind is that this is how you know if a jobs number was disappointing. So they were expecting that there'd be 160 to 170,000 jobs created. There was only 38,000. That destroyed the dollar. Why did it destroy the dollar? Because now they cannot in any way, shape, or form hike rates. No matter what they say, they cannot risk that. So that begs the question, does that mean that they are going to do more quantitative easing? Are they going to have to go to negative interest rates to kind of keep the stock market afloat? Because that's kind of the name of the game. And so that gets pretty interesting. And in the premium video, I went over some of the internal indicators that actually show that the internals right now are actually pretty bearish, at least for a short-term kind of a pullback. But the bigger question here is that, what happens next? What are going to be some great trades over the next couple of weeks? Well, with the dollar going down, gold is a good one. I talked about a couple of stocks in the premium video as well. But let's focus on the euro here. So the euro obviously moves opposite of the dollar. It's not that Europe is in any great shape, but really keep in mind is that you've got the U.S. economy and the European economy. And if one is perceived as slowing down at a greater rate than the other, that currency will fall against the other one. So that's a long way of saying that even though I'm not really a huge fan of the European economy, as long as the dollar is under pressure, the euro is going to go higher. Okay, probably a safer way to play this is with the Canadian dollar. So the Canadian dollar had a nice move up. It's come down. It's actually at a kind of a viable pullback. And of course, with dollar weakness, this would continue to sell off as well. One interesting play on Friday was AVGO. This was, I think it used to be Broadcom, and they had earnings. So this was just kind of a simple put credit spread, kind of an at the money spread, as well as some out of the money puts. And this was nice. It was easy. It actually just kind of moved the expected move higher. So all the options that we sold expire worthless. And so the question comes up is that, is there another opportunity to do that on this stock? Well, one of the things I've found is that when a stock has good earnings like this, okay, it tends to actually trade sideways for a couple of days and potentially weeks. And an example of this is Coors. So Coors had a good move up with those earnings, and you never know if it's going to keep on going up. I mean, maybe it'll keep on going up, but the odds of it continuing to go sideways are actually pretty high. So on something like that, then all you have to do is sell an at-the-money put credit spread after the earnings come out. And so in this case, on Coors, we sold the 46.42 put credit spread, and as this thing kind of ground its way higher into the end of the week, you can see right now it's 10 cents. I probably should have bought it back, though I've got some comfortable room. We got still 7 more days on this, but I'll look at buying this back next week. Ideally, if these $46 puts fall to a nickel, I can buy them back here and essentially commission free, buy back the short side for a nickel on Thinkorswim there, and it's commission free. So that's a couple things we're looking at there, and really from there we're just watching the stock market next week. We do have some indicators that are starting to get a little bit more bearish, i.e. the skew is almost at 135, the 10-day moving average, the put call ratio is dropping, and that is all short-term bearish. So it doesn't mean that the quote unquote the top's in, but I'm certainly looking for pullbacks. And 3 to 4 points on the spiders, that's 30 or 40 S&P points, and that would time up with the squeeze losing momentum as well, and that's what I'm going to be focusing on next week. All right. And for those of you, this is going to be fun. So Tuesday night, Chris and I are going to be doing a webinar together. It's called the Dynamic Options Trader Blueprint. It's a free webinar. We're going to kind of go over some setups that we like, some new tools, and just kind of what's going on in the markets here. For those of you that are newer, what we're going to be focused on are precise short-term option setups for low-risk profits in volatile markets, from swing trading down to day trading. Okay, and then just kind of utilizing, what features to kind of utilize to really kind of stay on that. And what I've noticed in this market right now, if you guys haven't noticed, there's a lot of back and forth. There's not a lot of trends going on, so you need to have that flexibility. You need to be able to structure those option trades so that they can, manifest and knock it out like that. So anyway, it's going to be a fun webinar. It will be recorded. And I think that's everything. So where is the date on that? Yes, Tuesday, June 7th, 7 to 8 o'clock Central. That's 8 o'clock East Coast time, your name, your email, and you'll be good to go. All right, see you guys on the other side.